On May 15th, the Federal Reserve got a new leader, Kevin Warsh, who walks right into a $39 trillion national debt crisis. Warsh has signaled a desire to keep interest rates high to fight inflation, which puts him in direct conflict with the Trump administration's heavy political pressure to lower rates and boost the economy. The U.S. economy is currently carrying a 122. If they keep rates high to crush that inflation, economic growth slows down to a crawl, risking a severe recession. Navigating out of this corner isn't up to a single person. Warsh has to build consensus among 12 voting members inside the Federal Reserve, a group that is currently deeply divided on which path to take. The resulting vote will determine the market's underlying mechanics, creating a tailwind for one specific portfolio structure, while building a structural headwind for others. Before looking at the winning investments, it helps to understand who the guaranteed loser is, because historically, one specific group pays the price for these macroeconomic shifts. This chart shows the late 1970s rate hike cycle. You can see cumulative inflation skyrocketed to 52%, while wage growth lags severely at just 36%. Now, look what happens when we expand the timeline to include the massive rate cuts and money printing of 2008 and 2020. The wage growth line stays pinned underneath the inflation line through both cutting and hiking cycles. A salary alone buys you less stuff every single year. To simply maintain a baseline standard of living, the everyday wage earner is forced to step out onto the risk curve and buy assets. Sitting entirely in cash and hoping prices eventually come back down is a mathematical certainty for going broke. Let's look at the first scenario. If the Trump administration gets its way and the Fed lowers rates, we enter a stimulus environment. Cheap institutional capital floods the market. This comparison matrix shows how different asset classes react to that cheap money. We'll start by looking at the rate cut performance for broad stocks, real estate, and speculative assets. Broad index funds like the S&P 500 and real estate investment trusts, or REITs, experience strong, consistent growth. Corporate borrowing costs drop, and REITs are legally mandated to pass their profits directly to you as dividends. But speculative assets are where the mechanics of cheap money really take over. Assets like Bitcoin and aggressive tech growth funds capture massive exponential gains during these cycles. When Wall Street can borrow cash for 1 or 2%, they don't need a high return to justify the risk. So institutions pump billions into high upside growth funds, chasing any yield they can find. The downside is that these assets rely entirely on the endless flow of free money. The moment the Fed stops cutting and borrowing gets expensive, those sky-high valuations compress. The rate cut playbook generates wealth fast, but it demands precise market timing and exposes you to a total wipeout if inflation forces the Fed to reverse course. Now consider the alternate reality. If Kevin Warsh convinces the Fed to aggressively hike rates to kill off inflation, capital becomes expensive and the economy slows down. We can bring that same comparison matrix back, but now we'll add Treasury inflation-protected securities, or TIPS, and gold, mapping their performance during a rate hike. A TIPS fund like SCHP is a direct loan to the government, but the yield automatically adjusts upward to match government-reported inflation. It is a strict trade-off. These securities eliminate nominal losses, but they cap your portfolio's ability to grow beyond the rate of inflation. Gold is the other popular inflation hedge, but unlike stocks or real estate, physical gold is a non-productive asset. It doesn't produce a product, or generate any yield, or pay a dividend. Historically, gold tracks periods of extreme economic fear. It spikes during hyper-panic, like between 2008 and 2012, but flatlines for years the moment those fears subside. Adopting the rate hike playbook protects your purchasing power from being inflated away, but you sacrifice the compounding growth generated by broad market indexes. Because the Fed's next move comes down to a 12-member vote, guessing is a fool's errand. You have to map your capital directly to your personal risk tolerance. What is your primary goal? The preserve capital branch uses bonds to eliminate risk, though growth stays flat. Aggressive speculators take max upside, betting on crypto despite extreme volatility. Finally, agnostic growth relies on broad index funds to steadily compound wealth, ignoring Fed noise. But this path exacts a heavy psychological toll. You have to be willing to endure 20 to 30% portfolio drawdowns during rate hike cycles without panic selling. Choosing a strategy that conflicts with your actual financial timeline forces you to either sell at a loss during a drawdown or miss the growth needed to outpace rising costs. A $39 trillion debt wall is coming due. If history proves anything, it's that this incoming Federal Reserve cycle will ruthlessly reshape market valuations. Waiting on the sidelines for the economy to normalize is a fictional strategy. Volatility is the baseline now. Leaving capital completely unallocated allows inflation to silently erode the value of previous labor. Generational wealth grows through consistent positioning in a strategy you have the psychological discipline to